Have you ever wondered how the pros who manage billions seem to know what the market's going to do next? It kind of feels like magic, right? But their secret isn't some mystical crystal ball. It's actually a really rigorous, disciplined process. In this explainer, we're going to pull back the curtain and show you their playbook.
So, how do the experts try to predict the future? I mean, that's the billion-dollar question. And let me tell you, the answer isn't about making a lucky guess. It's a formal, structured process that underpins every single major investment decision they make.
What they use is a formal process, and it's called capital market expectations. So you can forget about gut feelings or hot tips from a friend. This is the systematic toolkit that professionals use to build a logical, cohesive view of the future for stocks, bonds, and, well, everything in between. It's their playbook for making smart, informed decisions.
All right, so here's what we're going to cover. We're going to walk through their entire playbook. We'll start with the real goal of forecasting, then break down their 7-step ritual. We'll look at why this is also difficult, explore the tools they use to read the economic tea leaves, and see how they use the economy's own rhythm, the business cycle, to guide their choices.
Okay, first up, the investor's crystal ball. Before we jump into the how, we really need to understand the why. What is the actual goal of all this forecasting? The answer? Well, it might just surprise you. So here it is, the first big insight. The main goal isn't to perfectly predict exactly where the S&P 500 will be next December. No, it's to build a set of forecasts that are internally consistent. That means their predictions for stocks, bonds, and inflation all have to make sense together. That logical framework is so much more valuable than one lucky guess. So how do they build that consistent framework? Well, they follow a very strict 7-step ritual. And I mean it, this isn't guesswork. It's a repeatable and documented process.
These are the core steps in their process. You can see how it flows from setting a goal, to doing the research, to modeling, and then interpretation. But look at that last step, number 7. That's the critical piece that makes this a living process, monitoring the results and feeding that information back into the system. It's a continuous loop of improvement, not just a one-time prediction.
Of course, if this were easy, we'd all be billionaires, right? The reality is that the crystal ball is incredibly cloudy. There are some huge challenges that make this process exceptionally difficult.
The first big problem is the data itself. Economic data is kind of like looking in the rearview mirror. We often find out about a recession months after it's already started. Definitions change over time, which makes comparing history tricky. And a huge issue is something called survivorship bias, where the data you see only includes the winners that made it, which can totally skew your perception of reality.
But hey, even if the data was somehow perfect, we'd still have another massive problem to deal with: our own brains. We are all, and I mean all of us, susceptible to psychological biases that can derail even the most careful analysis.
Just take a look at some of these common mental traps. There's anchoring bias, where an early, maybe even irrelevant number, like a stock's 52-week high, gets stuck in your head and messes with your decision. Or what about confirmation bias? That's where we subconsciously go looking for news that confirms what we already believe, like that our favorite stock is a surefire winner. These biases are working against us constantly.
And just to make things even harder, the world loves to throw curveballs. These are called exogenous shocks, and they are, by definition, completely unpredictable events. Think geopolitical crises, game-changing new technologies, or natural disasters. You just can't build these into a forecast.
So you might be thinking, okay, with flawed data, our biased minds, and a world full of unpredictable shocks, how does anyone even begin to make a forecast? Well, they rely on a toolkit of specific analytical methods. Let's take a look at how they try to read the economic tea leaves.
There are basically 3 main approaches. You've got these complex statistical economic models, which are really disciplined but often fail to predict major turning points in the economy. Then you have leading indicators, which are much simpler, but yeah, they can give off false signals. And finally, you have checklists, which are super flexible but can be very subjective. Since there's no single perfect tool, analysts often use a combination of all 3.
But no matter which tools an analyst uses, it all has to come back to this fundamental truth. Investment outcomes don't just happen in a vacuum. They are directly tied to the health of the real economy. Losing sight of that connection is one of the most basic and potentially costly mistakes any investor can make.
So here's the crucial takeaway from that. An economy's long-term potential growth rate that acts as a fundamental anchor. Think about it. Over the long run, the value of a country's stock market can't really grow much faster than its GDP. This trend provides a vital gravitational pull for both bond and equity return estimates.
Okay,
So let's zoom in from the long term to the medium term. While that long-term growth is our anchor, the economy doesn't move in a nice, straight line. It has a heartbeat, a rhythm, and we call that the business cycle. Understanding where we are in that cycle is absolutely critical.
A typical cycle has these 5 phases. And as you can see, different assets tend to perform best at different times. For example, during an initial recovery, when interest rates are low, riskier assets like small-cap stocks tend to do really well. But fast forward to a contraction, and safe haven government bonds are usually the place you want to be. This is essentially a roadmap for tactical allocation. So who influences this cycle? Well, there are 2 main levers of power. You've got monetary policy, which is controlled by central banks through things like interest rates, and they're usually trying to smooth out the cycle. And then you have fiscal policy, which is the government's tool, spending and taxes, usually aimed at longer-term goals.
So how do we get a hint about which path we're on, the sunny road to growth or the stormy one to recession? Well, one of the most powerful signals out there is the bond market's yield curve. It compares short-term and long-term interest rates, and when it inverts, which means it costs more to borrow for a short time than a long time, that suggests the market is expecting economic weakness ahead. It's not foolproof, but an inverted curve has been a pretty reliable warning that a recession might be on the horizon.
Okay, let's bring all this home for the final takeaway. After looking at the goals, the challenges, and all the tools, what's the ultimate lesson here? It's all about valuing the process over the prophecy.
And this really brings us to the most important message of all. The ultimate goal is not pinpoint accuracy for a single asset. What truly matters is building a framework where all your expectations for stocks, for bonds, for currencies are logically and internally consistent. That coherent worldview, that is the hallmark of a professional process. Because at the end of the day, this whole rigorous process is about one thing: making informed, disciplined, and defensible investment decisions. It's about having a documented reason for why your portfolio is positioned the way it is, rather than just chasing a hunch or trying to be a perfect fortune teller.
So the final thought I want to leave you with is this. The goal isn't a perfect forecast, but a prepared portfolio. This shifts the entire focus from prediction to preparation. It challenges us to ask a much better question. Not what is going to happen, but how am I prepared for whatever might happen.